Hey guys, welcome to the Wave Crypto Club. We talk about all things crypto. If that interests you, subscribe to the channel, tell your friend, like this video, hit the bell icon. In this video, we'll talk about something that you need to keep in mind before you think of getting into the crypto space. This is very important. Pay attention to each of them because if you don't, maybe you'll not really be happy about getting into the crypto space. There are 6 things that I really think you need to keep in mind: losing, bet, TAM, platform, timing, follow on. What are these? I'll talk about it. Nobody likes losing. Crypto investing is exactly like playing poker. You have a limited information with you. It goes in rounds. Right? You have a certain set of information when you're maybe taking a bet. You're taking a bet on whatever cards you have. Same way, you're taking a bet on whatever tokens you might want to invest into. And the most important thing is nobody likes losing, right? You don't like losing, I don't like losing, nobody likes losing their money. But it is important for you to get used to losing money. If you've ever played poker, you know that you're not going to win every round. You might lose a round, you might lose 2 rounds, you might lose 5 rounds in a row, but then you might win something. But that's how the game is. Crypto investing is actually like that. Because there are many tokens, 80-90% of the tokens that will go bust in the long run. We saw that happen to a few tokens just in the last few months. So psychologically, tune yourself to know that I might lose this. Right? That is the risk I'm willing to take. And only then decide to get into it. Right? It is like poker. So it's your choice. Based on the information that keeps coming, you can get out at any point of time. You can sell and exit. You might have small losses as the round increases, maybe the round size increases, so your losses will become bigger if it does become a loss. So you decide when you want to get out. Don't listen to anyone else. You decide, you do your research, you figure out what's happening and get out when you have to. Nobody likes losing money. Make many bets. So cryptos, like I mentioned, 80-90% will go bust. How do you hedge against that? You don't invest in one token. You don't invest in 2 tokens. You actually invest in 30 to 40 tokens. Why? Because the probability of something becoming 1000x is like 1-2%. If it's 1-2% probability that a token will become 1000x, then you need to have spread your investment into so many tokens that you actually get in striking range of that 1-2%. So evaluate the tokens. We talked about that in another video, how to evaluate. Once you evaluate, figure out the 30-40 tokens that you probably want to put your money into. And in those 30-40 tokens, maybe 1 or 2 will give you that 50-100x. Right? So make many bets. Then we talk about TAM, total addressable market. You might be investing in a token that is worth today $10 billion in market cap. But does the problem that this token is trying to solve even have a $10 billion addressable market? That is for you to figure out, right? Do some research. What is this token trying to solve? Is it trying to disrupt the ad market? Is it trying to create a better gaming experience? Is it trying to create a better experience for artists to create NFTs? What is the problem that it's solving? How does it work in terms of the business model? How big is this market? Figure that out. If it has a potential to be that big, then make your likely bet that, oh yeah, this is a big market. Hence this valuation makes sense. So you need to look at that. That's for you. Invest in platforms. So not sure if you've heard of the California gold rush. So in California in the 1800s, there was a gold rush. People figured that, you could apparently go there and dig for gold. So a lot of people started coming into California. They started to, start digging anywhere and everywhere, trying to find gold. But the people who really made money from that episode were people who sold the tools, people who sold shovels, people who sold food, right? People who sold things that these miners wanted. So, always invest in platforms, because if the end product succeeds or not, for instance, an NFT itself might fail, but a platform that helps in creating NFTs, that has a higher likelihood of success. Why? Because there are so many people who will try to make NFTs. Maybe one of them will become big, but the platform that is helping these people create NFTs, that will still be making a money on every transaction. Sure, the returns might be lower, but it's a safer return. Timing. So timing is everything. I'm sure all of you know this from your personal experiences. If you're not there at the right time, then you just might lose something. So ensure that you are investing at the right time. How do you know that? Only when you research, only when you go through the crypto markets, only when you're aware of what you're putting your money into, only then will you understand that the importance of timing. Only then will you know whether something is the right timing or not. In fact, timing, according to some study, is probably the most important factor for success in across more than 200 companies. Right? Not the team, not idea, not business model, not funding. Timing was the most important factor. So, make sure that you get your timing right, or at least as close to getting your timing right as possible. In this follow-on funding, don't invest all your money in one shot. Let's say you're planning to invest, 100,000. Think of it this way. Today, you evaluated some tokens, put maybe 30-40%, that number is for you to decide, but a smaller fraction of it today, and then invest into the winners a little later, 4 months, 6 months, 8 months later. Right? Why? Because of this. When you invest, right, what typically happens is some tokens after a while might go bust, like this red line here. Some tokens might just be flat, like this dark blue line here. Some tokens might be like a little bit tapering up, right? You might see that little bit spurt in growth. So you know that, hey, something's happening here. You need to do some research, figure out that, hey, there's some good shit happening. So when you realize that there's some good shit happening, then deploy your follow-on funding, that other 50-60% that you had saved, deploy that into those winners. Because when you do that, then you have the higher likelihood that that token might go up like this. This is very similar to startup investing. I've taken this chart from 500 startups. So, this is just to give you an idea that this is how you can double down on the winners and ensure that your portfolio is going to have that little bit extra edge, that little bit extra 20% growth by doing something as simple as this. Hope this made sense. Hope you enjoyed this video. If you liked it, like the video, share it with a friend, hit the bell icon, subscribe to the channel, and welcome to the Wave Crypto Club.